When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about why a rigid retirement plan can fail you. We'll also answer listener questions. And finally, risk analysis. Are you taking too much or too little? My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. It's a good long weekend. Started off nice being on the radio where I love. And I just want to reach out and say, first of all, how grateful I am for the freedoms that we have here in America and for all those that have basically laid their life on the line and served our country. I didn't serve in the military. I wanted to be a pilot and didn't have good enough eyes to fly and ended up not being needed. But it doesn't stop me from recognizing the importance of those that did decide to serve and those that put everything on the line for our benefit. So thank you to those who served.
I hope everybody else is enjoying a beautiful Memorial Day weekend here in Tucson. Maybe you're out by the pool today, firing up the grill, or just trying to beat the early desert heat before it hits triple digits. But it's also a time to remember what this weekend is really all about, Jeff. And that is honoring those who have given everything for our country. As you know, Jeff, it's interesting. A lot of people spend their whole lives working hard for freedom from a regular job, but when it comes time to retire, they don't always feel financially free, and that's where the right plan really does make a difference. Can you explain that, Jeff? Why does a right plan or a correct plan, why can that make all the difference versus just a plan?
Everybody's got a different story. Everybody's got different goals. No one can really see the future over 30 years or so during a retirement plan, but you have to have some direction, some guardrails, some constraints, and some goals. You can't just say, oh, well, I have this much, and Wall Street says the 4% rule is the right amount. So if I've got $1 million, I can use $40,000 of it a year and hope it doesn't blow up. You get some people that think, well, as long as you put half your money in bonds and half your money in the stock market, if the stock market crashes, you can actually take more because you can use the bond money. Well, what happens when the stock market takes 5 years to get back to even, but you've spent all your bond money? Now you've only got the 500,000 of the stock money left. You didn't double it. You have to wait till it doubles or triples before that happens. So some people just go back into the, not necessarily a rigid, but a haphazard rule of thumb plan. And that's probably even worse than a rigid plan, or worse than not really having a plan with diversification, true diversification, the different types of money, different buckets of money, different money for different things. So we believe that income and tax planning are paramount in a retirement plan. First of all, taxes are money that's gone, you can't get back. Sometimes stock market crashes is money that might go away, but it could come back. It usually does. But what about the income in the meantime? So we always build income plans. And from a standpoint of rigid, there has to be some sort of a structure that maybe it looks a little bit rigid. Maybe it looks like this is your budget. But typically when we do a retirement plan, we try to give a little bit more buffer up front when somebody retires as far as income-wise and even guaranteed income. And that's why we like to use annuities and LIRPs and things like that I've talked about, because it gives us less pressure to have to make money every year, year in, year out, month in, month out in the market-related investments, which are risky, and volatility kills a retirement plan, as I've mentioned so many times. And we've seen it when I repeat the story about Norm and other people that have dealt with volatility and retired at the wrong time, or used money at the wrong time, or had an emergency at the wrong time and had to take money out at a loss, and so forth. Having a plan is definitely the biggest deal. I think a bad plan is better than no plan. No plan is a plan to fail. A bad plan is just a plan that could possibly be tweaked, or at least gives us some direction, or at least points us in the right direction. If we start heading in the right direction and then find out that we're a little bit off, we can change. But if we go off into a dark space and have no idea where we're going, and then all of a sudden realize that we're lost, how are we going to find it if we're not at least heading sort of the right direction? So starting with a plan is the best thing. I don't think anybody has a perfect plan, although I think after we've done this for 30 or 40 years, we found out that our plans are flexible enough to work. And I think people don't necessarily see them as rigid plans or flexible plans. They just figure that's a plan that works, that has enough buffer for those what ifs. And every time we do an annual review and reset the plan, we realize that we're on track because something didn't perform, something else did perform. Or if something didn't perform, they didn't need to use it anyway because their income has already been guaranteed through paychecks every month through their pensions or their Social Security that we've optimized. And then the investments either generate interest or some sort of an income. We like guaranteed income for retirement planning. We also like tax efficient income for retirement planning. And I'm not talking about municipal bonds that pay 2 or 3% and bonds that could go up or down in value if you have to cash them in or use them along the way. So we're talking risk off, meaning giving that risk to somebody that manages risk, that limits or eliminates the risk so that you can have the peace of mind of having income. But a plan is really where it all starts. And whether it's considered rigid or flexible, a plan has to incorporate a little bit of unknowns ahead. Nobody knows what interest rates are going to be a year from now. Nobody knows what housing costs, medical costs, what Social Security is going to be paying, whether they're going to restrict it. So there has to be some sort of a buffer, some sort of, an educated guess. You've got to at least go in making reasonable assumptions, maybe shooting low so that you're always surprised when it overperforms and not being too disappointed if it underperforms. So those are kind of the basics of planning. But again, it's not necessarily about having a perfect plan because nobody knows exactly what's going to happen every day of the next 30 years. But we do know that we can point you in the right direction, and we know where the obstacles are in the waters that we're sailing through, and we can avoid them if we already know what to look for and what to avoid.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about a rigid retirement plan versus a flexible or an agile retirement plan. So, Jeff, when you say a rigid plan versus an agile or a flexible plan, how is a plan made flexible or agile? What are the flexibility factors or agility that we're really looking for to bake into a plan to make it work as you age?
Well, I don't think flexibility means not having something that isn't flexible in the plan. For example, guaranteed income shouldn't be flexible. The only flexibility it should have is it could go up if the markets do better than expected. But things that can't go down or can't disappoint you are important. And when you get guarantees, sometimes you have to, some people might say tie up money or lock up money. Well, you did that when you paid into Social Security. It's pretty much locked up. Government has control over it, and you get it when they say you can. You don't have any control over that. But people love that Social Security check because it pays some of the bills. They also love their pension checks. They can't control that. Most of the time, you can't take a lump sum. If you can, you typically do and control it yourself. But bottom line is that money that you set aside or your company set aside for a pension is also set aside. It's tied up. It's not that flexible. However, the cool thing about managing your own pensions when we use LIRPs and index annuities is it is your money. Let's say you're taking income and you get sick when you're 80 and you still have half your account left and you want to move to a place with better assisted living. You want to use more of that money. Well, you don't have to just be stuck with the income check when you know you've got plenty to live another 3 or 4 years and your life expectancy is maybe half of that. Then you can have access to that money. You can't turn up the payments on Social Security and get the rest of your trust fund early. You can't do that with a pension that's governed by a pension fund or a corporation or a company. So taking control and sometimes even making a rigid plan isn't as rigid as you think, as long as you're in control of that plan and have as many of those assets that you can accessible for those emergencies and those what ifs and those unforeseen events. The other thing is the flexibility really comes from your liquidity portion. And one of the things I like about LIRPs, life insurance retirement plans, is it's like a tax-free bank account that you can just keep throwing chunks of money into. It grows tax-free. You never actually take the money out. You borrow it. And it alone is tax-free. Never shows up on a 1099, never makes your means-tested things like IRMA, your Medicare premiums, go up. And it's flexible. The thing is you don't have to take monthly income. You can take a chunk out anytime you want to do something fun or anytime you have an emergency or anytime you want to send a grandkid to college and pay the tuition or whatever and take an extra chunk of money out of an account that never generates a tax return. That's flexibility, in my opinion. Some people think, well, I don't want to tie up all my money in a LIRP. Well, you're not. You're just basically buying your own tax-free bank account. You own it. You can use it how you want to. Now, you can also divest it and run it dry and basically blow your business up too. But if you treat each of those entities that generate cash or generate tax savings or generate a return on your investment that's either guaranteed or protected, or even if it isn't, even if it's stock market stuff, if each of those buckets of money, if you want to call them buckets or boxes or different categories of retirement funds, treat them each like a business. They're there to do a job for you. You have to manage them, but they're there to provide a benefit. They're there to provide a return on your investment. And it can be done in several different ways. I like using all the tools in the bag. I think it's funny how some guy was on a phone conference not too long ago calling himself, well, we're a true fiduciary, so we only do stock market stuff. How can a true fiduciary only do stock market stuff when you're supposed to be doing the right thing for the people? And there's products that can create guaranteed income, tax-free money, death benefits, long-term care benefits, all these things that the securities can't generate just because somehow they justify getting a fee for life on your money, cha-ching, cha-ching every month for the rest of your life, instead of somebody parking some money in a bucket, getting a commission one time, and you being set for life in that category. We use those other assets. We use all the asset classes that will help you feel confident, be more secure, save taxes, pay all your bills, and have the flexibility and even the capacity to take more risk on those funds that you have set aside for the market, for risk, the liquidity, the stuff that doesn't have to generate income or be tapped every month. So again, sometimes people think, oh, well, I can't, if I put this money in this bucket, this money in that bucket, then my plan's not flexible. Well, yeah, it is. Each bucket is flexible to its own degree. But the fact is you can take more or less out of each bucket when you need it. You might not want it every year. You might have different plans for trips and travel and different things that come up. So not everything can be a direct, hey, I get this much every month and I have to live within a budget and I'm constrained and I can't have any fun because all my bills take up exactly what I've been given as my allowance. That's not what we're to do. We're supposed to help you feel comfortable in retirement by structuring a plan that helps you live easily within the income that you've chosen, have a buffer, and then deal with the rest of it on a responsible level based on your risk tolerance and your values. Do you want to just shoot for the fences, never touch the money in a Roth and leave it for your kids tax-free? I mean, that could be part of your plan if you've got tons of income coming in and you never think you'll tap it. Or you could say, I just want that there for my rainy day money and I don't want it to ever be down in case I need it. So I want to take less risk on that money. That's fine too. So everybody's got a different risk tolerance, different goals, and a different amount that they've saved. I think it's funny that sometimes the people that have the most saved are happy with a 2 or 3% safe return guaranteed when they could afford to risk and swing for the fences on half their money and go from 20 million to 50 million. Instead, they're just happy being at 20 million and not losing money and living on the interest. That's fine. So sometimes it's the people that have less money that probably need to be a little more aggressive with some of it just for those rainy days in the future, because maybe $1 million isn't enough to provide income and cover all the future expenses. Maybe 3/4 of it's good enough to provide the income. The other quarter of it can be invested in something long-term that might take a little bit of risk so it can grow, either for a nest egg for retirement or a nest egg for the nursing home or a legacy for your children or whatever. So again, it doesn't really matter how much money you have, how much risk you want or how much risk you should tolerate. But then again, if you don't have enough money to risk and it's on the low end, you don't want to risk any of it. So everybody's got a different risk tolerance, different need, different bill structure, different lifestyle. And each plan has to be flexible from the standpoint of developing that plan, very flexible to accommodate the needs, the wishes, and the values of each person and each household individually. However, once you set the plan up, it's also got to be a little bit flexible for those unknowns in the future.
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the importance of having an agile or a flexible retirement plan because, of course, in retirement, as you change, your plan needs to follow suit as well, too. If you do not have a flexible plan, if your plan is very rigid, maybe you want to put a little more flexibility into your plan, call us here at Premier Retirement. Schedule a sit down with Jeff. No cost, no obligation to do that. 520-780-9059. It's 520-780-9059. There is no cost, there is no obligation for this complimentary consultation with Jeff. It is a one-on-one casual conversation to put you on a path towards a confident retirement and with a flexible and agile retirement plan. Okay, Jeff, let's get back to our conversation here. Let's talk about the market because that's where a lot of plans break down. The market certainly does not stay in one place for a very long period of time. How does that relate to our conversation about having a flexible plan?
I think a flexible plan is you don't ever want to be relying on money that could go down or be very volatile on a regular basis. I mean, that's why we set aside money for income to be safe, principal protected income, or even guaranteed income and insured income that guarantees that you get a paycheck every month, no matter how long you live, no matter how good or bad the market performs. And if the market performs well, you get a raise. If it doesn't, then you'd never get a pay decrease. The flexibility in the stock market, I think it's people kind of have that itch to win. We're a prosperous country. We've had a good market over the years, average returns in the 10% range. It's a good place to make money, but we've also had returns. I just looked at one stock and I'll just give you some perspective on it. The stock market took about 10 years from 2000 to 2010. It was kind of like the lost decade. If you look at the NASDAQ, when it crashed from the dot-com bubble in 2000, it took 14 years before it actually made back the difference and rose above that level. So you're basically stagnant for 14 years. If you had all your money in that type of an account and were using money, you'd have turned into Norm, the example that I used that actually did retire in 2000, had $1 million, needed to use 40 or 50,000 of it and ran out of money because the market plummeted and he never recovered on the money he spent. It took 14 years to recover. In fact, I met him 10 years into the program and told him it wasn't going to last. He's taken too much out and it wasn't going to happen. So, we got to make sure that we don't be the norm, especially when we buy into the market or stay in the market and decide we can retire based on our current values when the market is at an all-time high. I mean, we're bragging about all these all-time highs, but every crash has come after a series of all-time highs. I mean, think about it. That's what happens. And every bull market has come after a crash. A bull market doesn't follow a bull market. Bull market comes after a correction or a crash, and then it goes bull, and then it corrects and does its thing. So we have to be careful about just risk in general and make sure that it's not money that you rely on a regular basis. I was going to say about that one stock, I just saw a chart. In fact, our portfolio had it in it, and we just sold out when earnings came out. Cisco was a company that was just really on a roll in the year 2000. I didn't realize it, but it was about a week or so ago when Cisco finally made it back to its original value from the year 2000. That's a 26-year deficit that stock was at. So if you're a buy and holder and you had Cisco, a great company, somebody everybody knows in the tech business, and you would have invested in the late 90s and 2000 era, and you were just hanging on because it's going to come back, it's going to come back, I know it's going to come back. Well, if you're 65 when the market crashes and you've got stocks like Cisco, and you have to wait to age 90 before they even get back to even, I think something's going to happen along the way where you're going to need to cash some of that stock in, pay a bill, or go on a trip, or help a kid out, or just take care of a medical expense or something that might require you to lock in a loss on that. So again, you have to be very understanding of the market. Now, that's just one stock out of many, but the fact is the market in general, I mean, who knows? That was one of those stocks that would be compared today to the Magnificent Seven, the Microsofts and the Apples and the Netflix and Teslas of the world, but it wasn't anymore. It came and went, and now it's back, sort of, because the AI business is putting it back on the map. But could that happen to Microsoft and Apple and those companies? I suppose it could. I mean, shoot, it happened to one of the biggest, most actively traded and most successful companies on the planet in the 90s. So anything can happen. We always think that this time is different. The fact is the markets do what markets do. It always repeats. It just never looks quite the same. We go back to the mid 1800s, 150, 170 years ago. We had a great boom in the market, all based on railroads. That came and went. It was a bust. Then we had the 1900s, early 1900s. Car companies came out, Ford, Chevy, a whole bunch of names that we don't even know because more than half of them were out of business in 20 years. You had that boom, and then you had different booms along the way. You had the tech bubble, then you had the real estate bubble in the '08, then now we've got another tech bubble. They all end badly. The bubbles all pop. This time it's going to be different. We're going to somehow sneak our way because of algorithms through this one. I don't know. I think those algorithms are going to get tired too. The fact is algorithms are still based on past history. Can it change past history? Can it change cycles? I don't think so. Can it change emotions? I don't know. We got a big bond market that is surging because oil prices are going up. If oil stays up above, I heard the number 110 a barrel. If it stays up there for 2 or 3 weeks, the Fed chairman's going to be forced to raise interest rates just to curb the inflation numbers. And if that happens, that hurts tech. If that starts to sell off, all these companies that are way overvalued, the surge in semiconductors of 50 or 60% just year to date. And even the oil and energy sector is going up, but it's causing the inflation. So it's actually where some of that money's been rotating to. I have a feeling we're going to see a lot of catalysts. In fact, we're seeing the money rotate in and out of different market sectors on a daily basis. It used to be like every couple of weeks, we'd see kind of a shift, or every month or so, we'd see a shift, and we could kind of follow the money. Right now, you can't even follow money. Every day you wake up, it's like Groundhog Day. We got all these market makers trying to pump tech and put out bids, and then they end up selling it and buying bonds. So right now, they're giving signs that the market is tired, that the smart money's moving to cash, that this hype can only last so long. And we might be on the verge of another bubble popping. Now, we are in a bubble. We're in an everything bubble, and we have been for a couple of years. Does that mean we can't make money in it? Well, we've done pretty well making money in the last couple of years on our growth funds. And most people have hung in the market. Indexes have done well and set new highs. Not really fundamentally based by any means, even though they say that there's been some gains and some earnings. A lot of them are one-time earnings from sales of stocks or sales of businesses and things like that that are kind of faking the numbers. But can that be sustainable? Is that all pre-sales? Is that all based on future price earnings, based on bets of the future, or is it actually based on today's earnings? And most of them aren't based on today's earnings, they're based on future earnings, what they call guidance. And so there's a lot of smoke and mirrors in the market right now. There has been for a while, but I'm seeing it come in kind of to a place that the market's moving so erratically and so irrationally and so quickly both ways for whatever news somebody hears or whatever earnings report comes in, good or bad. Everything seems a little counterintuitive right now. So yeah, my gut hurts watching it. It's exciting. I love managing our portfolios, but it's getting increasingly nerve-wracking watching the smart money gear up for a good market correction. So, I think now's a good time, if you're not thinking about it, to maybe restructure some of the risks, take some of that risk off the table, count your many blessings, and start using those principal protected accounts if you haven't already. I think the people that have been using the principal protected accounts, most of them have been, the last year or so especially, have been keeping up with or beating CDs by a pretty good margin in safe protected assets. Some of those assets are the indexed principal protected products, index annuities that provide income, and some of them are just safe havens to provide income. CDs are not paying 4 or 5% like they used to. They're lower, even though interest rates may go up. I don't think we're going to see 5 or 6% CDs, too soon. Maybe we will again. I don't know. But I think it's going to be hard to lock in some good interest rates in spite of the inflationary situation. I think interest rates are going to go up, and it's going to hurt businesses. It's going to hurt homeownership. It's going to hurt the economy. It might be the catalyst that gives us that recession that, honestly, I hate to say we need, but without a recession, we're not going to reset to a normal place again. And the markets always get back to some sort of an equilibrium place where it makes sense again. Investors can invest with a little bit more confidence and understanding of what they're buying, why they're buying it. And there's some sort of a fundamental basis for making investments in the market. Right now, it's really hard to see, but other than the hype, it's the AI hype. And like I said, every bubble that's been hyped before has popped. And it's just a matter of time before this one does. Hope we're on the right train at the right time, or we get off at the right stop before it crashes.
All right, Jeff, we've been talking about how to build a flexible retirement plan. So how do you actually go about doing that?
Well, we just find out what your goals are. We see where your assets are now, find out what tax bracket you're in, what your guaranteed income sources are, how much guaranteed income you would like, how much of those assets could be moved to assets that are principal protected and guarantee income, how many of those assets need to be moved to a tax haven like a Roth IRA or a LIRP, which is usually for after-tax money in addition to a Roth if people have it, or if you want to cash out of an IRA and do a little bit of divesting into a Roth and a LIRP, that's one way to get the taxes out of the way now. It's just a matter of time that the IRS is going to come for those taxes, and sometimes people see that it might be smarter to pay taxes over the next 4 or 5 years and be done paying taxes, or done paying taxes at a 20% or higher level. We have people that live on more than a couple $100,000 a year. They're still in the 12% or less tax bracket because we've done some tax plannings out of the gate, or they've done some tax planning along the way. Most people typically get to us after a job and say, okay, now what? My job always kept me in a high enough tax bracket. It didn't make sense to do a Roth. And you're probably correct. But now that you're retired, you think you're in a lower tax bracket, but that's only going to be for a small portion of time before you have to start taking that pre-tax money, the IRAs, the 401k money out when you're 73 or 75, depending on how old you are. Then what happens? You go back into a high tax bracket again. So you have this little reprieve where you feel good about things. You think life is getting good, and then all of a sudden it isn't getting good. So everybody's life expectancy, everybody's goals and everything, but that has to be kind of on you. But once we decide how those assets should be allocated, we can make a plan that'll generate income, give you some buffer, and keep you in a tax bracket that's palatable. So again, really just comes with a discovery meeting to figure out where you are. And we'll tell you how the people on our boat have been floating and how they've been doing it with confidence, how we've been avoiding the obstacles on the ride, and how we can help you do the same. I used an analogy a few weeks ago, and somebody came in, and I guess it was a client. They listened to the radio and go, oh man, I love that boat analogy. So I'll repeat it. We've been sailing the ships into the waters of retirement for 40 years now, and took us the first 10 to find out where all the obstacles, rocks were, and how to get back to shore safely. We've been doing it for years and years, and thousands of people got on and off our boat over the years. We've got a full boat, but since we've been in business quite a long time, some of those people are getting off the boat, if you know what I mean. There's room for more, but would you rather jump on a boat that knows where it's going, that's been through the waters of retirement and knows where all the obstacles are, or you want to go rent a boat and do it your first time on your own? You can if you want. Good luck. You might end up getting surprised by the first submerged rock that's just below the surface and end up sinking your boat. So hopefully that doesn't happen. But that's where we are. We're the skipper of a boat that's been sailing these waters, and we know how to drive it. Come see how we do it. Come see how our happy clients are doing. And if our boat doesn't go the direction you want, find somebody else driving a different boat. Not all boats are the same. Not all boats go to the same places. Maybe you want a boat that goes to one destination, and we're not going there because we think it's too risky or too hard to get there and don't have a lot of confidence in the route to get there. If you find somebody else that does, that they think they can make it, then, well, good luck. Jump on their boat. I'm not saying we're the only ones that know how to do it, but we've been doing it long enough time. We haven't seen our clients go to the poorhouse or file bankruptcy. We've tried to help clients that got there somewhere else and then come to us and try to fix it. Sometimes we can't fix broken. You can't undo dead. A dead retirement plan can't be revived. Unfortunately, that's the way it is. So again, you only have one chance to retire. You probably only have one chance to do your retirement plan. You want to do it on a one-off basis because of a couple of things you read that are printed by people that have an agenda and have one thing to sell, or do you want to deal with a comprehensive financial advisor that's a fiduciary that actually looks at the big picture and has been doing it for a lot of other happy people.
Great conversation, Jeff. Want to talk to our listeners here for just a moment before the break today. At Premier Retirement Planning and Wealth Management, we're building customized, agile, flexible retirement roadmap plans that look at all of it, income, investments, and long-term strategy, so you're not locked into a plan that cannot be adjusted. So call right now to get your retirement roadmap, 520-780-9059. You can also find out more about us online at premret.com. Jeff, time for a break for news. When we come back, we'll be answering listener questions, and later on, we'll discuss whether your risk tolerance versus risk capacity is costing you money. When our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for making us a part of your Memorial Day weekend. We appreciate you listening to us here for Premier Retirement. By the way, we're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., also Sundays at 11 a.m., and as always, we're a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows, literally hundreds of our past shows, so you can stay on top of your journey towards a confident retirement. Once again, our number, 520-780-9059. If you'd like to come in and talk to Jeff in a casual circumstance about your journey up that retirement mountain, again, there's no cost and there is no obligation. 520-780-9059. The person that you're hearing on the radio today is a person you'll be talking to, not some junior advisor. So if you'd like to talk to Jeff, again, 520-780-9059. Again, it is entirely complimentary. Okay, Jeff, time for listener questions. We'll start with Richard listening to us in Catalina Foothills. Richard says, my older cousin is 77, has $2 million in his pre-tax IRA-type accounts. He does not have and has never had a Roth account. My question is, if he were to start a Roth account today, via a Roth conversion, would he be subject to the 5-year rule? He's trying to figure out if converting some of his IRA to a Roth is a good idea at his age, which is 77.
Well, everybody is subject to the Roth IRA rule, the 5-year rule, but I don't think anybody knows what the 5-year rule really is, because everybody says, oh, I can't touch my IRA for 5 years. That's not true. The only thing about the 5-year Roth rule is when you convert to a Roth, you can't touch any of the gains for 5 years. So if you rolled $400,000 over the next 4 years into a Roth account, you would pay tax on that $400,000, and you could pull $400,000 out of that Roth before you have to worry about it. So if you don't use $400,000 in the next 5 years, you're good. So again, the 5-year rule doesn't start with every new investment either. It starts with when you open the Roth account. So you can continue to convert. And once you're in the 5th year, if you convert the 6th year, you can use that money in its entirety right away. So the 5-year time frame clock starts the day you open the Roth, and it only applies to the gains, not the principal. You've already paid tax on the principal. You can use that, spend it, do whatever you want with it. So there's first misconception out of the way. Now, in order for me to answer the rest of the question, I need to know a lot of stuff. First of all, if your cousin has a whole bunch of extra income and he's already in like a 30% tax bracket, I don't know if converting is really a good idea, because you're just going to be pushed into a higher tax bracket to do the conversions. If your older cousin, who is 77, has, let's say, $20,000 a year in Social Security income and everything else is the $2 million in his IRA, and if he's married, he can still pull out about $100,000 or more out of that IRA and still be in a 12% tax bracket. Now, if he's single, he could pull out close to $200,000 and still be in a 24 bracket. But since he's 77, an IRA at that age, he's going to have to take roughly $100,000, $110,000 out, but it'll go up every year, and have to pay taxes on it at 12 or 22 or maybe 24, depending on his other sources of income. So without the other source of income and knowing his tax bracket or his marital status and how he files his taxes, it's really hard to say whether it makes any sense to convert to a Roth. Now, to do a lump sum Roth, I don't think he has enough years left to catch up to the amount of money that he would be out at close to 40% combined taxes in order to just lop it off and be done. I have had some clients that are so mad about taxes, they're willing to do that, and they want to do that, and they don't care if they only have $1 million or so left, because they don't have enough bills to worry about it, and they just don't want to ever pay tax again. So to each his own. But if you look at the numbers, the math does not support doing a huge conversion at his age, unless he knows he's going to live to 95 or 100 maybe. And then you get past that break-even point from paying a higher rate of taxes in order to save a low rate later. So if he's in a position that he's always going to be nipping at the 22 to 24 tax bracket, then maybe you do convert an extra 100,000 a year for a little while just to help mitigate those increasing required minimum distributions as he gets older. I mean, as he pushes age 90, he's going to have to start taking 10% out of that IRA, which if it keeps making 6 or 8%, he's going to still have more than $2 million in there. At that point, he's got $200,000 in income plus a Social Security. So now he's out of that 24 bracket, depending on what they've done to the brackets and whether or not the tax returns or the tax rates have gone back to the pre-Trump tax cut era. A lot is really unknown. So I need more information before I can answer that question. But at least you know the understanding of how the Roth works. I would probably never see a situation where it would make sense at his age to do a lump sum cash in everything unless that just was a value play. But it probably would not make sense with the math. But then we have some algorithms and some software that'll tell us exactly what the math means, what the break-even point is. You have to assume the tax rates are going to stay the same, or assume what you think the tax rates are going to be in the future, assume what your rate of return is, et cetera, in order to do that. But you could come up with the different scenarios and we can play around with the numbers and see if it makes any sense.
Richard, that's a good question. Thanks for listening to us there in Catalina Foothills. And again, Jeff needs just a little bit more info. If you'd like to continue this conversation, call us here at the office, 520-780-9059. It's not going to cost you a dime to sit down with Jeff, 520-780-9059. You can call that number today, leave your name and number. Shelley will call you back during the week and arrange that consultation. Okay, Jeff, Stanley is listening to us in Tucson. Stan says, Jeff, my wife has a MIGA that has grown from $36,000 to $50,000 and is now maturing. We don't really need the income. We've got a pension, Social Security, and other annuities covering our lifestyle, but I hate the idea of taking a lump sum and paying taxes on the gain. Should we take the payment, turn it into income, or just roll it into another annuity?
Well, again, it's hard to say. I don't know what your tax bracket is. I mean, if you're living on Social Security, you've got your pension. I don't know how much that is, but if between you, let's say your total income is, 90 grand, or total, let's say income's 100,000, and you've got 14,000 in gains, you're still, as a married couple, you're still in the 12% tax bracket. So I'd say, so what? Pay the taxes and put it in some place that isn't taxable. Or you just hate paying the taxes at 12%. I think that's cheap. You could continue to roll it, and then your kids could inherit that money if you never use it and pay taxes at their tax rate. And if they're still working, making $400,000 a year, they're going to pay taxes at a 30 to 40% rate. So I don't know. It's probably not that big a deal in your situation. 14,000, a lot of money. But if that just really bothers you, roll it to another MIGA. There are some MIGAs that are pushing 5.5%, 6% if you want to lock it in for 5 to 10 years. Good A-rated companies are doing that too, better than 5. I don't know how long you had that MIGA to get from 36 to 50, but it must have had a pretty decent interest rate. You didn't get it just 5 years ago. You got it a while back, and it pays some pretty good interest. So you can roll it again and do what's called a 1035 exchange. Don't have to pay taxes. It just rolls over, which is really why I like MIGAs way better than CDs. Even if you were to buy a 2 or 3 year CD, buy a 2 or 3 year MIGA. You don't have to pay any taxes on the interest until it rolls over. And then if you want to roll it to a new one, you don't pay taxes. Unfortunately, the CDs, you pay taxes whether you use the money or not. And MIGAs, a multi-year guaranteed annuity. That's what MIGA stand for those listeners who are wondering what this archaic language is we're coming up with. No, it's basically a jargon for a multi-year guaranteed annuity. In other words, it'll guarantee a fixed rate for multiple years. Now, some of the caveats to those multi-year guaranteed annuities is it'll renew at whatever the current rate is if you don't tell them within 30 days prior to when it matures. So be careful you're already on it and know what you want to do before it matures, because sometimes a 5% 5-year MIGA might renew at 3% as its minimum rate unless you tell them to do something different. So you better watch those close to maturity. I don't know that it's purposefully a trick. I think it's just because the insurance company doesn't know what interest rates are going to be in the future, and they want to make sure that they don't get hurt. But at the same time, I think it is a chance for them to take advantage of you and not just renew at the current rate, rather renew at a minimum rate. So be careful on what you have. Be careful on what you roll to. The other option you could do is if you like where the interest rates are now, and maybe you got this so long ago, you didn't really have good options with a fixed indexed annuity, you might want to consider rolling it into a fixed index annuity where if you're not using the money and you want it to grow more than a multi-year guaranteed annuity, the guarantee would be 0 instead of 4 or 5 or 6, but you could make 10 or 12% like some of the indexes are making the last couple of years. Now, if the market crashes, you're not going to make anything, but you're not going to lose anything. Whereas if the market crashes on a MIGA, you're still going to make the 5% or whatever it pays. If the market goes up, you're still going to make the 5%. With zero risk, that's a real easy pill to swallow. With the index annuities, you're going to have to just kind of take what the market throws, just knowing you're never going to lose money. But you do have the upside of potentially beating a 5% return. And if you look at history, most of the indexes that we can get today at today's current interest rates, not 5 years ago when interest rates were zero, you couldn't get these, but today you can get a much higher participation in the market or in those indexes, which would result in 5 to 10% is not an unrealistic rate of return over a period of 8 or 10 years. In fact, if you look at the last 30 years and pick the best and the worst 10-year period out of it based on current interest rates and current indexes, some of them pay anywhere from like 4 to 15%. So you got quite a range. Knowing you'll never lose money, it might be worth 4 to 12%, might be something you're willing to risk instead of a guaranteed 5, knowing that that's all you can make. So there's different options. And depending on how old you are and how many other assets you might have that are in non-performing or taxable deferred assets, you might even want to consider a LIRP, a life insurance retirement plan. Maybe you've got $250,000, 50 is just one of those things. And you said you've got other annuities that are covering your bills. That's great. That's generating some income. But maybe these little bits of income push you into a higher tax bracket because those other annuities are, have you at 200,000 where you're now hitting the 24 bracket and you don't want to go there. If that's the case, then maybe you bite the bullet, pay the 22 tax on this MIGA and maybe other CDs and things that you have, and look at a LIRP, which is a tax-free bucket of money that doesn't generate a 1099, that never gets taxed again. And if they change the Trump tax cuts to the old tax rules, and your tax rates go up, you'll be real happy that you have a tax-free place to park your money. So again, a lot of options, but of course the latter, the LIRP requires good health and probably a younger age. So if you're in your late 70s, you're way past prime. If you're in your 60s, it's probably a good time to look for it if you're in good health.
Stan, good question. Thanks for listening to us in Tucson. Again, Jeff's number 520-780-9059 if you'd like to continue the conversation or if you'd like to bring your cousin in who is age 77. Keith's in Dove Mountain, and Keith says, what are your thoughts on principal-protected structured ETFs and using them in part of his more liquid section of his investment pie cake?
I've seen those principal-protected structured ETFs. I don't think any of them is a zero protection. If they are, they don't outperform the annuities that I use. There are some that are buffered. I think that's probably what you're trying to talk to, the structured ETFs that have buffers that give you the most you can lose is like 10%, or they're buffered to the point where you protected to the point where you don't lose the first 15% of the down market, but let's say the stock market goes down 50%, then you do lose the 35. So they're buffered to either the first amount lost, or you could say, well, I lose the first 10%, but if it keeps going down, I don't lose any more. But on the upside, they're also limited because in order to provide that type of an opportunity, you need to use options, and options cost money. And ETFs, although they have typically a very low management fee, in order to run anything that's protected and structured, is going to have some sort of a option structure or something where there's some costs involved with protecting those assets. So, if it's true protected, great. If it's really liquid, the protected secured ETFs aren't going to pay anywhere near the upside of something that has a longer term contract. In my opinion, if we sold the ETFs, we'd probably make more money over a 10-year period than we would on an annuity because we get fees on that. If you know a place, you just want to do it your own, be a do-it-yourselfer, well, do some research, make sure you do the due diligence and make sure you really understand what you're getting. Because most people that have those things don't realize they're still, even though they're principal protected, not zero risk, sometimes they're principal protected only to a certain degree. So just make sure you know what you're getting into before you jump in. We haven't found an opportunity to use them, just like we've just not found in over 20 years an opportunity to use a variable annuity. There's plenty of annuities that cost a lot less that provide the income you want and the security you want. And if you want upside, don't put it in a variable annuity that has high fees. Use ETFs like you're talking about that use lower fees. So I think the reason that the principal protected structured ETFs came around is because people didn't like the heavy layered fees in variable annuities. They still wanted some sort of principal protection. Some variable annuities gave you like a death benefit protection where you'd never get back less than you put in if you died. But what's the cost of doing that? Well, you have to die to get that benefit if the market's down. And if the market's up, then you just paid a big fee for something you didn't get or you didn't need. Or there's a certain amount of income that you can get from them because it's not necessarily protected principally, but it's protected for an income base. So I think these ETFs have been kind of invented for those people that became a little bit more fee sensitive, and they should with variables. Oh my gosh, the fees are horrible. I just don't know how they're legal, actually. Well, everything's legal. They disclaim all the fees, and they're in there, but they don't make a lot of sense to me. The math doesn't prove out. And I think ETFs are kind of a way to buffer that to where you have some sort of a feeling of security, but then you're still in the securities. You're still in the risk market. ETFs are still securities. They still generally have risk. CDs are not securities. They don't have risk. Fixed annuities aren't securities. They don't have risk. Isn't it interesting? All the things that don't have risk are not called securities, and everything that's called a security has risk. Just kind of a word game. I think Wall Street loves the idea that it puts some sense of security in your head that thinks that principal protected means it's all protected, and it may not be. So again, if you show me the prospectuses and show me what you're looking at, I can have a better idea of which one you're talking about or what structure you mean. But be careful. There's a lot of people that think they have principal protection in ETFs that don't.
Keith, very good question. Thanks for listening to us in Dove Mountain. And again, if you'd like to talk to Jeff, 520-780-9059. If you've got a question, you'd like to get it to us and give us a shot to answer it on the air, you can get it to us by calling it in to 520-780-9059, or you can go out to the website, premret.com, and you can use contact page there, and we would love to talk to you. Once again, if you would like to sit down with Jeff on a one-on-one basis and talk about your journey towards confident retirement, climbing that retirement mountain, call 520-780-9059. The cost is absolutely zero, no cost, no obligation, no judgment. We'll meet you where you are. Again, it's 520-780-9059. You can also request it online at premret.com. Jeff, a lot of people confuse risk tolerance with risk capacity, and I think they understand their risk, but they still get burned in retirement. What are they missing here about risk tolerance versus risk capacity?
Well, tolerance is how much does your stomach hurt when the market goes up and down when you watch your money doing it? Do you get sick on a roller coaster, or do you ride it out just fine? Thing is, do you really need a roller coaster ride? Maybe you don't. You know, your risk capacity, somebody that has $20 million has tons of risk capacity because they live on $200,000 a year, and that's like stupid easy to do without risking anything. But you could probably risk $18 million of that. But that doesn't mean you have risk tolerance. In fact, it's funny, I see the people that have a lot more net worth tend to have less, they have more risk capacity, they have less risk tolerance, because when you have tens of millions of dollars, a 4% market correction is huge on a statement. If you've got $400,000, a 4% market correction, 16 grand, and it's not life-changing. So yeah, everybody's got a different perspective. And so when we build a plan, we have to realize what your gut check is going to be when the market corrects 10% as opposed to corrects 20, or even gets into a bear market territory and crashes 50 like it did the last two times it went down really big. You don't want to be scared money where you think all of a sudden you've got to grab it and run for the door. We're very conscientious of the fact that the market's overvalued, and we're probably a lot more jumpy now managing money than we have been in the past, because we don't want to ride the next market crash down and we think we're on the verge of one. But long term, you don't want to be riding that roller coaster going like, oh my gosh, the next 10 years of my life is betting on the market doesn't have a crash. Well, that's probably a long time to make a bet on that. If you bet, well, this year it might not, I think we've got a chance that it won't. We've got a good chance that it will, based on some of the recent earnings, kind of not so good surprises, some of the walk backs of some of the guidance that some of these companies have given as far as, well, maybe it isn't that big, and maybe the market isn't that big, or maybe we're not going to collect all the market, or yeah, I don't know. There's a lot of AI hype out there. A lot of stocks are still hype, just like there was .com hype, where 3/4 of the companies weren't even in existence after 2001. They were just a ticker symbol with a price tag. It's just something you've got to always be ready and understand what your risk tolerance is. And if you find out too late that you think you have risk capacity, maybe you haven't been retired too long, and you've never really worried about risk because you had a paycheck. Once you're getting a paycheck in retirement, you might just find out what your risk tolerance really is. After the first 5% correction, if it makes you sick, then you don't have a whole lot. If it takes 20% before you start getting uneasy, then maybe you're moderate. And if you say, well, it doesn't matter, I don't care if it goes down 50%, I can never lose because I've got so much income, I don't need it, then maybe you've got a really high risk tolerance and high risk capacity. They don't always go hand in hand, but again, one is more emotional. The other is just basically financial, based on your lifestyle needs, income needs, tax bracket, and so forth. And the other is, again, purely emotional. So yeah, when we do a plan, we have to kind of dig in and find out where you're at on all those things. And hopefully we do a good job. And if we don't, we'll find out really soon when the market starts taking a couple of bounces. Might need to tweak the risk tolerance a little bit and risk off a bit. Or when you find out that it really doesn't bug you, maybe we should take some of those penalty-free withdrawals out of your principal protected accounts and go more into risk because you like the excitement that it brings, and you found out you don't really need to live on as much income as you thought. So again, it can be tweaked both ways. Everybody has changes happen during their lifetime. Some people are not too risk averse in their 60s. When they get in their 70s and 80s, they just get tired of dealing with it. So they just get tired of it and they don't want it anymore. It's okay. Some people say, well, gee, I've made so much money, I don't really care anymore. Just put it all at risk. We'll throw it in a Roth IRA and try to make my kids as much money as I can when I die. Everybody's got different things that happen throughout their lifetime, throughout their retirement years. And the cool thing about risk tolerance and risk capacity both is that you can adjust your plan accordingly as you find out you have more or less of one or the other.
Talking with Jeff Vogan on Premier Retirement Planning and Wealth Management about risk capacity and risk tolerance. Many times people get these confused. And Jeff, if you confuse risk tolerance versus risk capacity, what are the possibilities that could result from this? Could you be leaving too much money on the table, or could you lose it all?
Well, two things could happen. Now, if we're watching the plan and we're having our regular meetings and you're keeping in touch with it, we're doing our job. We kind of know what markets are doing. We also aren't going to put you in a plan that we don't feel confident in. So in other words, we're going to feel confident working with people that are willing to secure at least their income portion. But when it comes to the risk part, some people don't like taking big risks, and that's okay. If it's more important to be mentally okay every morning and not have the bad news of a stock market correction in front of them when they turn the TV on, then maybe it's okay. But at the same time, you're probably leaving some money on the table. If inflation peaks a little higher than it is and continues to go up for a bit, especially with this oil situation that we're dealing with in the Middle East, it looks like the inflation numbers are creeping up, not down, then you might really wish you had some upside in the stock market the next 10 or 20 years so that you keep up and have that buying power that you might need for those discretionary things that may come up in the future. So you don't want to be too conservative, but that's why if we do a plan and we fix that income to a comfortable level, it helps people feel more confident taking bigger risks in the amount that's parked in the market. However, some people have a big risk tolerance and maybe not the capacity. They need the money every month. They're going to have to be, and they get really nervous if the market corrects because they've got all their money with some risk. Even if it's stocks and bonds, they probably have a whole bunch of underperforming assets in their account that are trying to create income from, and then they've got the more volatile accounts separate. But nevertheless, all of that can go down at the same time, just like we found out in 2022. In that correction, when bonds fell 20 or 30%, the 20-year bond's still down at least that. So that's really never recovered. So if that was your safe money account, you're still down 20%. If you're using that account, you're locking in losses after loss. Fortunately, the market's bounced back. And if you've had some of that, the profits from there to use, you've been able to kind of mitigate the losses on the bonds from taking those. But I don't know if bonds are going to go down anytime soon or up anytime soon. I think they're going down because of inflation. In fact, we're seeing the bond market go down. More people are buying bonds and interest rates are going up. Unfortunately, the prices are going down, but they're locking in higher interest rates. So you have to be able to make adjustments along the way. But you also have to realize that there is a proper balance that you need to kind of start with and understand. I shared this a while back, but one of our poster children accounts, a client came in and they said they had this Monte Carlo simulation. This was back in the Raytheon days when they had Fidelity as their 401k plan, and they went on and did this Monte Carlo simulation, and it came back saying that they had a 78% chance of living on their preferred lifestyle, even though they had a couple $1 million in their 401k and a pretty decent amount of savings. They came in thinking, well, 78%, that's good, but we're still worried about the 22%. Well, rightly so. And it's interesting. They said that they went back to Fidelity and said, hey, how come we have a possibility of not making it in retirement the 35 years that we're planning? And they said, oh, well, it's probably because you have everything in stock market related assets. And because of volatility, you've got to take out less because bad market years, you're going to lock in losses, taking that income out, and you have to dial it back a bit. So what you need is you just need more bonds, more low interest, but more secure type investments. So they basically did a 50-50 split and showed that they only had like a 72% chance. I don't know if that was the exact number, but it was less than the 78% chance they had going all risk. So it just goes to show you that if you use the securities model, the Wall Street model, it's really kind of hard to find that happy medium because, you really have to kind of adjust to the fact that every asset in Wall Street is volatile. And you have to be careful on how much income you plan to take out, or you have to be very nimble and flexible on how much income you want to live on, depending on how the market is.
Risk tolerance versus risk capacity. This is one of the most important conversations that I think that you can have, because it's not about just taking risk. It's about taking the right risk. Talking with Jeff Vogan here of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Once again, if you would like to get in and sit down with Jeff and talk about risk capacity versus risk tolerance, Call 520-780-9059. You can make that call right now if you want. Leave your name, number, and Shelley will call you back during the week and set up that appointment. No cost, no obligation, no judgment. It's 520-780-9059. We're also online at premierat.com. Well, Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank the fine citizens here of Tucson, Arizona for joining us. So for Jeff Vogan, I'm Jeff Shade, wishing you a happy Memorial Day weekend. Get out there and enjoy yourself, stay safe, and remember what Memorial Day is really all about. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.